Welcome to Tendency Forex. We will bring you the latest Forex news. The US dollar has strengthened modestly during the Asian trading session ahead of an important week that will prove pivotal for performance through the rest of this year. The US dollar has been in a holding pattern over the past week, while market participants await fresh catalysts from the release of the latest US CPI report and FOMC meeting. We have found that US CPI report releases have triggered larger market reactions in recent months, as speculation intensifies over a turning point for inflation and a shift in the Fed's policy stance. Ahead of the next US CPI released, market participants are anticipating further confirmation that underlying inflation pressures are beginning to ease from an elevated starting point, which if confirmed should keep the US dollar on a softer footing heading into year-end. On this occasion, though, an upside inflation surprise poses a greater risk of triggering a bigger market reaction after the sharp weakening of the US dollar over the past month. The US CPI report has the potential to overshadow the impact from the latest FOMC meeting. The Fed has been clear that it plans to deliver a smaller 50 BP hike this week. US dollar performance will be driven mainly by 2 points. First, whether Chair Powell signals clearly that another step down in the pace of hikes is likely at the next FOMC meeting, posing downside risks for the US dollar. Second, whether the Fed signals that the policy rate will need to be raised to a higher peak above 5.0% in 2023, and remain higher for longer in 2024, posing upside risks for the US dollar. The previous dot plot from September signaled that the Fed planned to raise rates to around 4.6% by the end of next year, followed by relatively modest rate cuts in the following years when the policy rate was expected to drop back to 3.9% in 2024 and 2.9% by 2025. Rates were expected to remain in restrictive territory over the forecast period. In comparison, the U.S. rate market current expects the Fed's policy rate to end next year at 4.6% before dropping back more sharply to 3.2% by the end of 2024. It highlights that while market participants expect rates to rise to a higher peak in the year ahead, they are not convinced that the Fed will keep rates higher for longer, given the Fed has tended to cut rates at a faster pace when a recession takes on hold. While we are confident that the US dollar has now peaked alongside US inflation, and expect both to weaken further in year ahead, there is a material risk that the upcoming US CPI and FOMC meetings could trigger a US dollar short squeeze heading into year-end. A stronger core inflation reading would be the most disruptive outcome for markets. If you enjoy this, don't forget to subscribe to our channel.